Why nobody can afford a home anymore. Have you ever looked at house prices and wondered if everyone else secretly won the lottery except you? It honestly feels that way. Buying a home used to feel like a normal life goal. Now it feels like running after a finish line that keeps moving. Years ago, many middle-class families bought houses with one steady paycheck. Today, even couples making good money struggle to qualify for mortgages. People love blaming greedy investors or expensive neighborhoods, but the story runs much deeper. Homes did not suddenly become magical. Wages simply failed to keep pace, while construction costs, housing shortages, zoning rules, insurance, and mortgage rates all climbed together. Weirdly, expensive loans do not always make prices collapse because there still are not enough homes available. Then psychology jumps in. Everyone sees homeownership as security, success, and proof they finally made it. Fear of missing out pushes buyers beyond comfortable budgets, while sellers expect even bigger offers. Suddenly, everyone fuels the same cycle without realizing it. Who really pays the tariffs? Tariffs sound like something politicians argue about on television, right? But the funny part is that your shopping cart eventually joins the debate. A lot of people assume foreign companies happily pay those extra taxes. Nice idea, but that is rarely how it works. Importers usually pay first. Then businesses face a choice: accept smaller profits or raise prices. Guess which option happens more often? The extra cost quietly travels through factories, warehouses, shipping companies, retailers, and finally lands on the price tag you see. Here is where it gets interesting. Even products proudly made in America can become more expensive if parts, materials, or ingredients still come from overseas. So tariffs may help protect certain industries while also making everyday purchases cost more. That changes how families spend money and can add pressure to inflation. Which naturally leads to the next question. If prices keep climbing anyway, why not just create more money and solve everything overnight? Why can't we just print more money? Be honest. Have you ever thought the government could simply print extra money and make everyone's problems disappear? It sounds almost too easy. The strange thing is that governments throughout history have tried exactly that. The problem is not printing paper. The problem is keeping trust alive. Money only works because people believe it will still buy groceries, pay rent, and create opportunities tomorrow. Once that confidence starts slipping, prices usually move much faster than anyone expects. That is why inflation feels so sneaky. Your savings slowly buy less. Paychecks struggle to catch up. Small increases at the grocery store or gas station seem harmless until they quietly reshape your monthly budget. Years later, you wonder where your money went. This also explains something many people never question. $1 is not automatically equal to £1 or £1, because every economy earns, borrows, produces, and inspires confidence differently every single day. Why is $1 not equal to 1 or 1? At first glance, $1, £1, and £1 all look like the same thing. They are all money, so what gives? The surprising answer is that money is really about confidence, not just numbers printed on paper. Exchange rates constantly move because investors, businesses, governments, and central banks react to growth, inflation, interest rates, trade, and expectations about the future. Sounds complicated, but think about popularity in high school. Reputation changes everything. Currencies work similarly. Here is the twist almost nobody expects. A stronger currency is not automatically better. If it becomes too valuable, American products become more expensive overseas, making exports harder to sell. A weaker currency can boost exports, while making imported goods cost more at home. Every exchange rate reflects millions of tiny decisions happening around the world every day. Once you understand that, another question pops up. Why are governments drowning in debt despite collecting taxes every year? Why every country is in debt and who they owe? Hearing that America owes trillions of dollars sounds terrifying. It almost feels like checking your credit card after a month of bad decisions. But national debt works very differently from personal debt. Governments borrow because they need money for roads, defense, healthcare, education, disaster relief, and countless other services before tax revenue covers everything. Instead of borrowing from one giant lender, they sell treasury securities that investors willingly buy. Here is the part most people never hear. A huge share of that debt is actually owned by Americans through retirement accounts, pension funds, banks, mutual funds, and insurance companies. Foreign governments also buy treasuries because they are considered among the safest investments available. Debt often reflects confidence instead of immediate disaster. The real issue is whether the economy keeps growing fast enough. If borrowing rises while growth slows, interest payments eat larger portions of government budgets, creating difficult choices for everyone. People use debt to get richer. This one sounds completely backward. Most people dream about becoming debt-free, yet many wealthy investors actively look for chances to borrow more. Why would anyone do that? Because they see debt as a tool instead of a punishment. They are not borrowing to buy bigger televisions or luxury vacations. They borrow to purchase assets that can earn more than the loan costs. After years of relatively low interest rates, qualified borrowers gained access to cheap capital, making this strategy even more common. Real estate investors, business owners, and private equity firms often control assets worth far more than their own cash. If those investments grow or produce reliable income, returns can easily beat borrowing costs. Many wealthy people rarely sell valuable assets. Instead, they borrow against appreciating stocks, businesses, or property, while those assets continue growing. It demands discipline because leverage magnifies mistakes, but access to affordable credit often becomes their biggest long-term advantage. The truth about private credit and why the rich keep finding more money. Have you ever wondered why wealthy companies always seem to find money so easily, while regular people fight through endless paperwork just to borrow a little? It feels unfair, but the answer is more interesting than most people realize. Most of us picture borrowing as walking into a bank and asking for a loan. The reality is much bigger. Behind the scenes is a fast-growing world called private credit, where investment firms lend directly to businesses without traditional banks in the middle. As banking rules became stricter over the past decade, private lenders stepped in to fill the gap. Here is the crazy part. Much of that money actually comes from pension funds, university endowments, insurance companies, and wealthy investors chasing higher returns. Billions of dollars get pooled together to finance business deals, commercial real estate, and corporate growth. You may never borrow from one of these funds, but your retirement account could already be investing in them. Another interesting twist is that money usually follows assets. A company already owns valuable property or generates strong cash flow. Lenders compete to offer financing. Regular households rarely get those same opportunities. The system is not built to punish anyone. It simply rewards people who already have financial strength. And once that cycle starts, wealth often grows faster because access to money becomes easier every year. How money laundering actually works: when people hear money laundering, they imagine action movies, secret warehouses, and criminals carrying bags stuffed with cash. Reality is way less dramatic and honestly much smarter. The biggest challenge is not making illegal money. It is spending it without raising red flags. Banks and government agencies monitor unusual transactions, so criminals need their money to look completely normal. Investigators often describe the process in 3 simple stages. First, the money enters the financial system. Next, it moves through many complicated transactions that hide where it originally came from. Finally, it returns looking like legitimate business income. Sounds almost boring, right? That is exactly why many schemes involve ordinary businesses, shell companies, luxury real estate, or international transfers instead of secret underground operations. Technology has made these schemes more sophisticated, but financial institutions have become much better at spotting suspicious patterns too. Here's the part most people never think about. Fighting financial crime costs billions of dollars every year. Banks invest heavily in fraud detection, identity verification, and compliance systems to satisfy federal regulations. Those costs eventually become part of the financial system everyone uses. Even honest people indirectly pay for preventing dishonest behavior. Once you understand how money moves legally and illegally, you naturally start asking a much more useful question. How can regular people build wealth without playing dangerous games? Trading, investing, and why your income matters more than you think. Have you ever met someone who checks stock prices every 5 minutes, calls it investing? It happens all the time, but trading and investing are completely different games. Trading focuses on short-term price moves. Investing focuses on owning assets that hopefully grow over many years. Neither approach is automatically right or wrong. It depends on your goals, knowledge, available time, and ability to stay calm when markets get emotional. Here is something surprising. Research consistently shows that frequent trading often performs worse than long-term investing once taxes, fees, and emotional decisions are included. Why? Because humans are terrible at staying rational, panic when prices fall, and get excited after prices already exploded higher. Sound familiar? The biggest enemy usually is not the market. It is our own brain. Then there is another piece people ignore: side hustles. Building a small business, freelancing, or learning valuable skills creates extra income instead of hoping investments magically grow faster. More cash flow gives you more opportunities to invest later. In many situations, earning another $1,000 matters far more than squeezing 1% from your portfolio. Wealth grows faster when income and investing work together instead of competing against each other. What Bitcoin and stablecoins really? Remember when people laughed at Bitcoin and called it fake internet money? Funny how quickly that conversation changed. Bitcoin introduced a simple but powerful idea. What if people could send money without needing a traditional bank to approve every transaction? Instead, thousands of computers maintain a shared blockchain that records everything transparently. Here's where people get confused. Bitcoin and stablecoins are not trying to solve the same problem. Bitcoin has a limited supply of 21 million coins, making scarcity one of its biggest features. Stablecoins work differently. They aim to keep a stable value by connecting themselves to assets like the US dollar. That makes them much more practical for payments, transfers, and many financial applications where price stability matters. The really interesting part is not even crypto itself. Blockchain technology is attracting attention from banks, payment companies, and even central banks looking for faster and more transparent financial systems. Whether cryptocurrencies completely reshape finance or remain a specialized investment, they have already changed how millions of people think about money, ownership, and trust. And another technology is now changing those decisions even faster. How AI is quietly changing your money. Do you ever feel like technology somehow knows what you need before you do? That is AI already working behind the scenes. It is not just futuristic robots anymore. Banks use AI to detect fraud in real time. Investment firms analyze massive amounts of data with it. Customer service, budgeting apps, and personalized financial recommendations increasingly rely on AI too. Most people interact with it every day without even noticing. Here is the surprising shift. AI is changing behavior as much as technology. Comparing prices, automating savings, tracking subscriptions, and receiving instant financial advice has never been easier. But there is another side. AI also makes scams smarter. Fake voices, convincing phishing messages, and realistic fraud are improving incredibly fast. Digital judgment is becoming just as valuable as financial knowledge. Here is the biggest lesson. AI does not magically create wealth. It amplifies whatever habits already exist. Good habits become more powerful. Bad habits become more expensive. Which brings us to the biggest question of all. Will there be a recession in 2026? Have you ever noticed how every financial headline sounds like the world is ending? Housing, inflation, debt, investing, crypto, AI, interest rates. They seem unrelated until you zoom out. The truth is they are all connected. That is exactly why predicting recessions is so difficult. No single chart can tell the future because millions of consumers, businesses, governments, and investors constantly influence one another. Here is what surprises most people. Recessions are not proof the economy is broken forever. They are normal parts of economic cycles. Some begin after interest rates rise quickly. Others follow financial bubbles, global shocks, or falling consumer confidence. Economists watch employment, inflation, business investment, spending, and corporate earnings, because these signals often weaken first. Even then, nobody can predict the exact timing with certainty. Instead of obsessing over guessing the next recession, focus on something you actually control. Learn how money works. Recognize emotional decision-making before it controls you, building valuable skills that increase your income over time. Make thoughtful long-term decisions instead of reacting to scary headlines. You cannot control the economy, but you can absolutely control how prepared you are when the next chapter begins.